Morning, everybody. My name's Colin White, and I'm the founder of Credit Connect Media. Welcome to the fourth edition of the Online Lending Technology Think Tank series. The event's designed to bring together lender and credit professionals to discuss strategies and assess technological innovations that can play a role in producing customer outcome. Obviously, it's a key and pivotal time at the moment in the UK with household costs resulting from the pandemic, troubles in Ukraine. Seems like everything's against the UK at the moment in terms of what's going on, and maybe even the world, let's be honest. So rising interest rates, continuing inflation, but luckily we've got a new Prime Minister who's going to come along and solve everything, hopefully, or at least go some way to helping to alleviate some of these kind of different problems that we're facing at the moment. So at today's event, we'll try and go through all of that. And as you can see, we've got a real mixed sessions coming up today. So we're obviously starting in a second. We'll look at assessing credit risk. We've got some great speakers lined up for that one and that session and our future sessions. 10:40. So we'll have a break around about 10:25, 10:30, and then 10:45 for those who want to log into our next session and they're interested in measuring affordability. That's going to be our next session at 10:45. 11:55 digital lending, and then we'll finish up around 1 p.m. looking at regulations impact on lending, talking about things like consumer duty and things like that, and how that's really going to impact potentially what the future of lending really. But just wanted to quickly say as well, thank you to our sponsors to make today's event possible, Cool Miner and Experian for their fantastic support on this event. Really appreciate that. So thanks for that. Also want to mention that today you can really get involved with the event. So you'll see in front of you on your screen, there's lots of ways you can interact with the event today. We encourage you to do that. We want to hear your opinions. There's a lot going on, so it'd be great to get some questions coming in about that for our panel after you've heard their initial reactions and thoughts on how things are going to progress. So on the top left, you've got an eye for information button. That's all about today's event. On there, you can also, there's a link within the text where you can join up and sign up for the next session if you haven't done already. Down from that, you've got a picture of an icon which looks like a person, and on that you can view information on our speakers. There's a couple of things you can, and links and PDFs you can download across our different events today, so have a look at those as well. And then as the logos of our today's sponsors, and in their specific sessions you'll be able to download a bit of information about them as well. So we hope you enjoyed today's event and want you to participate like I mentioned. So there's two ways you can do that. The ideal way is to click on the speech icon and click on there, and you can ask questions. I'll feed them into our event chair and he will distribute them to the panel if they're appropriate. Feel free to comment as well. We're interested in that. Anything we don't cover off today, we'd love to ideally we'll be writing an event review in about a week's time, which we'll put on the Credit Connect news site. So any questions that we don't quite cover or don't cover in enough detail, we'll try and get some responses from our panel and they can feed that back into the review. The second part of that as well, we'll be running some event polls, so it'd be great if you can participate in that. Also give your feedback in the polls as well. Always interested in that. We're always looking at ways of making these events better. And then finally, you can join us on our social media using the hashtag LendTechTT. So the platform, social media platforms that we really only use are LinkedIn and Twitter. So it'd be great to get your feedback on that. So yeah. Let's move forward though, and we'll talk about assessing credit risk. The format for this event is I'm going to leave us shortly, not entirely, but Chris Warburton from RO Strategy, who's the chair for today's event, will introduce our panel speakers, start the discussion, and then we'll hear what our speakers have got to say about things moving forward. So Chris, if I can hand over to you, that'd be great.
Thanks, Colin. So so thanks very much. So welcome to the Lending Technology Think Tank with Credit Connect. My name's Colin said. My name's Chris Warburton. So I'm going to be chairing the event, trying to keep the conversation going. Although we've had an earlier conversation, so I think it's all going to work pretty well because people have got good things to say. A little bit of my background before we start. So I've spent the last sort of 20 years really within risk operations, looking at transforming processes across the customer life cycle, essentially everything from from lending and adjudication at the front end through credit collections at the back end. The last couple of years, I've been the director of our strategy, and we've run a series of video explainers, really exploring like technology, ideas, innovation within the credit collection. So Colin very kindly asked me to chair the event today. So the first session, this is the first session, is going to be around assessing credit risk. I mean, as Colin kind of said, we've sort of been a bit of a roller coaster in lending the last couple of years. We've had the global pandemic, which has impacted supply chains. We've all lived through that. We've had various amounts of government intervention that sort of impacted sort of credit scores and how we sort of adjudicate around credit risk. Now we've got an energy crisis that's happening with an inflationary and cost of living crisis, which is all affecting the economy and affordability going forward. And obviously we've just got another change politically as well. So there's been a real sort of like roller coaster the last couple of years. All of that's affecting the lending market, has affected the lending market and how we assess credit risk going forward. And so really that's the focus for this session, which is what have the impacts been? What do we need to adjust and how do we need to think about things going forward? What are the top things we've got to really focus on? So these are some of the topics we're going to sort of really walk through today with a great sort of panel. So on the panel, we've got, I'm going to ask everyone to introduce themselves in a minute. We've got Dawn Brown, who's the Chief Risk Officer for Tandem Bank. We've got Jon Timmis, who's the Head of Credit Risk for 247 Money. We've got Tim Rooney, who's the CEO of Salad Money. And we've got Karien Esterhuyse, who's the Chief Analytics Officer for Jaja Finance. So what I'm going to do is I'm just going to maybe just briefly introduce yourself, give you sort of an elevator speech around what you kind of do within the company. I mean, Dawn, do you want to just quickly go first, and then we'll kick on with a couple of questions.
Yeah, okay. So as Chris said, I'm CRO at Tandem Bank, and we basically offer sort of fairer, greener choices to retail customers. So they're really financial products such as personal loans, mortgages, car finance, all of which have a bit of a green twist. So I joined in April, so relatively recently. And previously I was CRO at Marsden Building Society. So very interesting from a sort of a lending perspective, going from a building society, 160 years old, really established, to Tandem, who got their banking license in 2018. So, same role, but very different organisations. I've been in financial services pretty much forever, since I graduated way back when. I first joined sort of credit risk back in 1998, where I was at Direct Line Financial Services. I also spent 11 years at Lloyds Banking Group, always in and around credit risk, but probably more around the sort of modelling side, capital and impairment, sort of IRB. And I've also been head of credit risk at Skipton Building Society, so been in financial services forever, and most of it has been in around credit risk.
Fabulous, thanks, Dawn. Jon, very quick overview.
Yeah, so Jon Timmis, I'm head of credit risk at 247 Money, so we're part of the Car Finance 247 kind of group, I suppose. So my background in terms of credit risk started off at MBA as an underwriter, as a credit cards there. Moved on to kind of strategy there. Have been through lots of different things within the credit risk and risk world in terms of debt collection at Optima Legal, part of the Capital Group. I've been in Lloyds in relation to the mortgage pricing kind of world and the kind of credit risk element in relation to that. Securitas Bank for a number of years, working in the kind of retail and motor bit in there. And then about 3 years I've been running the head of the credit department in 247 Money. So automotive finance.
Karien?
I'm currently at Jaja, and we took over the management of the Bank of Ireland AA and Post Office credit cards, and migrated it in October 2020. And since then, we've had the 120 million investment that's really set off our partnership with Asda, where we are doing the rewards and recognition credit card with them. I came from, I'd say, data foundation side. So I studied computer science and really passionate about data, and then moved into credit card world. So I've started my career in South Africa and then moved across into the UK, where I worked at Barclaycard on their international portfolios. I've spent quite a long time at Banquis, where I also worked on their Poland proposition and also on the loan side, and then had another venture over into the Europe side with Creditech Monedo. That's again was in Poland, Spain, India and Russia. So interesting different markets, always around the credit risk side, analytical side, and heavily profitability analysis focused as well. And then that strong link up on the consumer and understanding the customer experience side, always with that data foundation.
Fabulous. Thanks very much. And last but no means least, Tim, quick overview of yourself and Salad Money.
Yeah, hi everyone. My name's Tim Rooney. I'm the CEO at Salad Money. We are social enterprise lending up to £1,000 to people in the lower 4 deciles of income in the UK, specifically NHS and public sector workers. My background has been in and around consumer data. I spent some time at Experian, and I've also worked in a few fintech startups, particularly interested in open banking and consumer data sets.
So I think we've got a really great panel, actually. We've got lots of different industries or sub-industries within financial services across sort of almost like a spread of spectrum between sort of like from an affordability point of view into sort of where people target across different products as well. So I think it's going to be quite an interesting discussion. So that to start the discussion, I thought was really just to get a bit of an overview really around what do we think the market currently looks like? I mean, what does credit risk look like for lenders at the moment? I mean, are we in an expanding or a contracting market? And John, maybe I'll just come to you first for that question. I mean, what's your sense around what the market looks like? I mean, is it still growing, or are we going to see a contraction?
It depends which area of the market you're in, I suppose. So there is a definite demand for credit out there. So the demand is definitely out there from a consumer basis. Especially there's people that are struggling to kind of get by at the moment in time. So they need finance to be able to do that. In terms of the prime lenders, we are seeing a number of those people kind of pull back because they are struggling to necessarily get the default rates they are getting need to get to. So they need to pull back to kind of make sure that people can afford the loans in a different kind of way, that they can get that there isn't as many kind of risks out there. But the demand is still definitely high, especially in the car finance world. People that still need to get a car still are looking to get more and more a used vehicle that is more affordable. So people are trying to get a affordable finance at the moment.
And Dawn and Karien, what's your kind of take from from your markets, more maybe a little bit more on the prime side as well?
Yes, shall I go first? So we're definitely seeing an increase in demand, particularly around the sort of personal loan space. A lot of that we're actually seeing as being much more interested in consolidation, where there's an element of debt consolidation, and also towards smaller loans as well. So, definitely indicative of a sort of increased credit risk there in terms of the increased demand, but also the actual the composition of that as well.
On the prime side, it's interesting to see that the arrears rates, I say, are still holding. So it is true that conversations with those in difficulty are more difficult conversations, but the pressures, it's almost as if we know the pressures are coming, but they sort of just not visible and there yet. What we can observe from a behavior perspective is that people are definitely spending more on credit again. we've definitely seen that there was that contraction during the COVID period as people were saving and having not using credit cards as much, but that has definitely changed, especially with seasonality. That has definitely picked up, and I mean there's been a big surge in the credit card balances over the last 12 months. It's seen the fastest growth it's seen since 2005. So there's definitely that appetite for credit.
It does feel like people have sort of gone out and almost like spent over the summer to a certain extent. I mean, I suppose the question is, what does that mean for the future? And Tim, I'm kind of interested in your view from your sector of the market as well, in terms of what you think is going to go on from a portfolio point of view. And I think before we talked a little bit about changes in mix as well in the portfolio. But what are you guys seeing?
Well, I mean, clearly lending to people sub £1,000, they're typically individuals with low financial resilience. We've seen application numbers double in the last 12 months, which in some respects is quite sad. We've seen affordability and appropriateness of lending to these individuals come down. So our accept rates have fallen. I think using open banking, we've been able to see the effects of inflation on consumers, specifically on things like cost of living in terms of household groceries, expenditure on petrol, etc. So those things have continued through summer. I think our market's quite unusual insofar as the people that we're serving are actually trying to serve a need at that point in time. So there are peaks and flows. A lot of them are tied to monthly income and pay dates, but we are seeing the contraction of the affordable or disposable element of our application base, which is concerning.
Yeah. I mean, I suppose we talked a bit about sort of change in mix. You can sort of see that there's demand out there, but I mean, I suppose is the demand driven by, I was flippantly saying around sort of like people spending over the holidays, but there's also demand that can happen into a change of mix. So you were just saying around sort of maybe declining some, but I mean, you're seeing more coming down from maybe with those that had greater affordability now coming into sort of like your kind of world, which can generate demand, which might mean that some of the banks in the prime sector don't get to necessarily, they're searching for people with the right credit risk profile. So this is almost like this change of mix, almost like down the credit risk profile from an approval point of view.
Well, yeah, I mean, interestingly, the net income that we see displayed within open banking has certainly moved up. And I think there will be individuals from probably the near prime market that are looking for a loan with ourselves. So yeah, I think that mix is something that we'll see change in the next few months.
And from a prime point of view, maybe Jon and Karien, but from a prime point of view, if we're struggling to get approvals, I mean, do we need to change the way we're thinking about it? I mean, obviously the risk appetite is going to stay the same, but is it going to mean that we're going to like look at different kind of pricing in the market, those kind of things, just to try and maintain growth? Or because it seems like the demand's out there, it's just not at the right risk profile up at the top end.
The demand is definitely out there. I think to some degree it's about kind of helping our customers understanding the change that they have to go through, and to make sure that they can be affordable to essentially, because we are a brokerage business and a lending business, so it's to kind of help our customers understand that when they come in through the door, that it's more important they get an affordable loan. So if they need a car, get an affordable loan rather than necessarily the aspirational car or the ideal car that they want. It's basically, okay, well, we can give you a facility, but it needs to be this kind of car with a lower mileage. It might be a less interesting, fun, sporty car than you were looking for. It may not be that Audi anymore. That it may be a Hyundai that's more reliable and things like that, whatever. So it's trying to help our customers go through that, so we can make sure we can approve more, and that we can put the customers in the right asset that they can afford to maintain. So it's a combination of changing what we do, because we need to make sure the risk is right for both parties.
Yeah.
But also changing the customer behaviour so we can get those approved and we can keep those volumes up.
Yeah. Okay. And I suppose one of the things that we chatted about a little bit before was when you're doing affordability assessments, is one of the things we've got to think about is not just what affordability is today, and we're looking to the future here as well. It's like, what's the affordability going to be in the future as well? So I mean, like, how do we start thinking about that and factoring? How are you guys factoring this into your models? I mean, maybe Karien, you're nodding there. Just maybe explain a little bit about what your thoughts are on that, because that's quite a tricky one, because we've got energy prices sort of increasing, but this sort of cliff edge that we're all talking about in October as well with energy prices. But you know, how do we think about that into the like lending?
I think you're absolutely right, Chris. And I mean, you know, sort of historically, we've not really had to worry about inflation. So, you know, a lot of lenders have just been using sort of ONS expenditure data and using that within the affordability. And now that's, you know, it's out of date very, very quickly. And we know inflation's increasing rapidly. And so we just need to be a little bit more proactive in terms of how we're assessing expenditure, and open banking's been, you know, significant help in that. But also we need to factor further increases when we're looking at those affordability assessments. So it's much more around being proactive. And as Jon said, you know, we really need to focus on affordability, but also look at sort of future affordability, not just current affordability.
Yeah, we've gone about refreshing our thinking almost every 3 months. We've said we need to keep an eye on this because the situation keeps changing. If we read the headlines in the newspapers every day, there's just more scary numbers coming out every day. So for now, we've taken a forward-looking view based on the situation we had in June, and we are in the middle of refreshing our review now for the go forward. But I think the way to almost win at this is to think more of segments. There is definite different types of segments in the marketplace, and creating more bespoke views for the different segments will help make better decisions. And especially on the lower income side, there is definite more pressures for those types of customers, and that does make it hard to say yes to those customers as well, because they just don't have the same disposable income buffers as other income segments. But it is interesting that they are usually the customers that are able to manage their finances the best, because they are used to doing that. And I'm sure that's something that Tim sees on a daily basis.
I mean, you'd mentioned before a little bit about the difference between, so I suppose, affordability and resilience, right? So I mean, is that kind of what you're leading to there in terms of, like, I mean, it might be affordable now, but there's this concept around how resilient are they against future shocks as well.
Chris, I think what we see, and Karien mentioned this, is we see the percentage of disposable income that our applicants have. I have a sort of sneaking suspicion that they probably have more disposable income than stretched middle income earners, but we don't have those applicants to make the comparison. But I think our consumers, as I probably mentioned to you on our previous call last week, they're very much our best customers are the people that live to their means and not beyond their means. So we're looking very much trying to understand the nature of how our applicants use their disposable income during the course of a month. We think that our best customers probably have about 25% of net income as disposable income. Mm. Now, one of my theories is there's a cascade of delinquency where consumers' decisions, certainly that our consumers make decisions on a monthly basis as to who they're going to pay and who they're not going to pay. A lot of our customers have got damaged credit scores, so a missed payment on their credit file isn't going to impact them any further, but they will make decisions about who they're going to pay. And you see a full range of additional commit that people look to make or not make on a monthly basis. So I think affordability is the key for all of us, but it's the appropriateness of lending to those individuals and the propensity that they might have to pay us all back. So a lot of that we see, and we're now focused very much on the disposable income recognition rather than costs that those individuals have.
I suppose it's interesting just in sort of like almost like cohorts of affordability in terms of, some people are used to managing the money quite carefully, and you've sort of got this middle section maybe who are going to get a little bit into need to manage the money more carefully sort of going forward, and is that how much of a shock is that going to be, and how do you communicate that, particularly from a credit decision point of view, if you look at future energy shocks or future inflation as well, and just is that kind of mix in terms of like where we kind of focus. I mean, Jon, what's your kind of reaction to that?
Yeah, I mean, there will be different kind of customers that are impacted to kind of point of view perspective that she was saying there. So I think that for me, the different kind of customers that we have. So what kind of best way to describe it? The employment type, for example, will impact your ability to absorb a short-term shock. So there's a difference between a long-term affordability to basically say, okay, well, we can project that this person is when for Q2 2023, for example, when Cornwall are basically saying that the height of the energy price is going to be, so we can kind of protect them for that element. So there's an element we can forecast, but there's also an element that we need to understand about the different customers that are coming to us and about their ability to absorb those short-term shocks as well, because it's not just those things that we are paying on a daily basis that are going up. It's those things that when your boiler breaks. It's those things that if you're a self-employed plumber, the fact that you will have to be chasing those payments more than you would have done before. The amount that you're potentially earning may have increased, but that will go down if you are having to constantly chasing the kind of payments there. There's also an exposure to the different kind of employment types that the customers may have, based on whether or not they're going to be impacted by maybe a reduction in hours, a reduction in overtime. So people like the retail sector, distribution, things like that, whatever. So they may find, as we all cut back, as we're supposed to, that they will be impacted in terms of their ability to earn on a regular basis. So again, we're looking and thinking about the particular sectors, the particular types of customers that will be impacted the most, and where those spikes may be, and how we can change our affordability to account for these as well.
So if we look at almost like the risk adjudication models, I mean, is there extra information we need? I mean, Karien, you talked about different types of segments, thinking about segmentation in a different way, but is there extra data or extra information that could be kind of useful? I mean, and is it the data, or is it how we look at the data as well? That's the other thing that's kind of out there. I know we mentioned open banking already, but I mean, maybe just ask Dawn if you got any thoughts on other elements of data.
Yeah, I think it's both. I think there's definitely more that we can do in terms of the way that we use existing data. For example, we're just looking at sort of direct credit card balances as well, and just how those are changing. Whereas typically, I've not seen them used huge amounts in the past. So I think there's definitely opportunities for us to really do more with the data that we've already get from the credit bureau. But I think open banking as well is just giving us another source of information, and we're finding things like gambling percentages is particularly predictive at the moment, particularly if people are increasing the amount of income that they are using for gambling. So I think there's huge amounts that we can do with new sources of data, such as open banking as well. So I think there's a huge opportunity there.
So some of that brings into almost like, and we've chatted before on one of the previous calls, around almost like these like micro indicators around, it's almost like the detail around what's being spent on, and is that indicative maybe of future stress as well? Exactly. I mean, it's like there's a linkage there potentially as well.
I think that's absolutely right, and we think at the moment that a lot of the increase in the cost of living is being funded by increased credit card debt. But actually, if we start looking at what that credit card expenditure is being used for, then that gives us an idea of to the extent to which that might be true.
It would be interesting to look at like the shift that we're seeing from discretionary spend to non-discretionary spend as well. Mm-hmm. And it's great that you have that with open banking. And we're a little luckier on the credit card product as well, that we can see the change in behaviors of what customers are using the credit card for. So things that can be interesting again is those subscriptions people have signed up to, are those being cancelled now as people are trying to pull back and manage their spend in a different way?
Yeah, I know I've been cancelling some subscriptions, and that's almost like one of the first thing that goes. And is that sort of like, is that indicative of maybe, well, people are just being careful with the money, or is it could be indicative, I suppose, with other things that there could be maybe future problems coming up?
I think there's a mixture of both. I mean, Tim, I know you've kind of made this point before, haven't you, in terms of like it's what that person does. Up the behaviours from open banking are incredibly useful to understand. If that person is cancelling their Netflix subscription, but they're still carrying on spending £78, £90 a month on Sky, well, they're probably giving themselves a false sense of change of behaviour. They're thinking that they're doing the right kind of thing, but they're not really pulling back where they really need to do so. So it's open banking is an incredibly powerful tool to understand how those behaviours change over time and how they adapt to stress.
John, I'm going to pick you up on a point there. You said, people spending 70, 80, 90 pounds a month on Sky. When we first started in 2019, we were able to look in and see 4,000 or 6,000 data sets for a consumer. And I was shocked that people taking home £1,300, £1,400 net income a month were spending up to £110 a month on Sky. And you just think, you know what, if you didn't have that, that's an additional part of your income that you could use and might create resilience. If you're a public sector worker, if you're a nurse and you've worked a 12-hour shift and you've got 2 children and you come home and you can put them in front of a TV on Sky and they can watch that for 2 or 3 hours while you get your house in order, get dinner prepared, etc. So I think there's this sort of patriarchy that we need to be really careful about what people spend their money on. I mean, I would suggest that electricity and Sky are the last 2 things that people pay. Electricity powers the Skybox, but I do see that buy now, pay later is a real scourge that we're seeing. You don't get the balances buy now, pay later. You just see those installments coming in. 60% of our borrowers are female. In the age ranges of 18 to 35, buy now, pay later has devastated individuals who live at home with parents, and they have run up huge bills and huge commitments to buy now, pay later. So that's the real concern for me right now is the advent of new products. Some of the banks have bought out their own buy now, pay later products, and I just feel that that's quite indicative of people searching round for different forms of credit to satisfy themselves.
You raise an interesting point there, I suppose, around hierarchy of payment, or also like Maslow's hierarchy of needs to a certain extent, which I'd almost like put food even higher up on that, which is like people are going to eat and they're going to sort of heat their homes and those kind of things. I mean, how much, and it feels like with all the crises that are going on, we sort of seem to be moving up, right? So if we have inflation, that's going to hit food costs, and people are going to probably buy food first before they go to heat their homes. I mean, how much do we need to think about that, predict it, because it's all of it's taking money away from the disposable income at the end as well. I mean, how much of a danger do you think we're in, and how much do we need to be very careful about lending going forward?
Well, Liz is going to sort it all out for us on Thursday, Chris. I mean, I think we're all of an opinion that prices cannot continue to rise from where they are. So I think I'm really keen to find out what assistance is going to be given to individuals on Thursday and then work backwards from there. But having that buffer on disposable income is certainly where we are focused on at the moment.
And what do the other guys think? Jon and Karien?
I do think we're seeing a bit of a polarisation of customers at the moment. There does seem to be much more distinction between those that are starting to struggle and those that are actually managing to be a little bit more and actually put money aside and increase their savings or move their savings from longer term fixes to instant access. So I think there's definitely something that we're seeing along there. But I think there's more that we just need to understand in terms of what that looks like. But we've gone down the approach that, and I know there's there is a difference between affordability and credit score, but we have taken the opportunity to increase our credit score, so that we are trying to just take the sort of better quality applicants rather than just relying on changes in affordability.
I suppose there's a question there around how predictive do you think the credit scores, or how reliable do you think they're going to be going forward? I mean, we've obviously had the pandemic, and we talked about this in previous sessions, that sort of changed credit scores historically. But we've got what seems to be fairly radical changes that are happening, even in terms of energy costs. I mean, we've not seen an energy shock since the 70s. I think we're looking at higher inflation now than we've seen since the 70s. I mean, like some of the models, do we need to think about the models themselves in terms of assessing risk, like how we react to that, to look at it going forward? I mean, is what we have today, is that predictive enough going forward, or we should be in good shape as long as we're sort of conservative?
I think the credit score is missing a lot of the details that are really making impact, which is kind of the point we've been making in terms of those things which aren't reporting on the credit files, or aren't generally reporting on the credit files. Things like food, your energy bills, your basic costs of living things, that they're not basically being reported. So unless you do open banking, you haven't got the facility to understand those. And even with open banking, you need to understand how those costs are going to be in the future. See this on the future look for those. But the other thing I think we need is, if we are going to be doing these assessments, we need to do these assessments on a long-term basis, whether the customer can afford and sustain the loan. We need to understand what that looks like in terms of how much to factor in the kind of future costs on a more individualistic basis than your standard, like the ONS things that a lot of the industry still uses in a kind of great amount level. We need to have those kind of assessments as to how the customer will be impacted on as much an individual level as we can get. We need to understand where they live, how the cost may change based on where they live, what they do for a living, and things like that, and how to get to the sustainability aspect.
Yeah, and obviously we've got this I think this financial event, I think, that's going to happen on Thursday. I mean, where there may or may not be intervention in the energy market or not. I mean, how reliable do you think those are going to be? Even if there is an intervention, let's say there's a price pattern happening, John. I mean, is that going to change the models, or do we have to have a sort of a bit of? I mean, things seem to be changing so fast. I mean, how do we sort of take that, the need for flexibility, uncertainty, and so what can often be sort of like quarterly refreshes or 6 monthly refreshes in terms of credit risk assessment?
I think that's really important, Chris. Just in terms of, I'm a big fan of scorecards and models generally, and it's probably my sort of background of having built scorecards way back when. But as I say, I am a big fan of them. But I think we just need to look at what data we throw into those scorecards, and what data we've actually got available, and what data we look at as being predictive. Because I think the sort of historic things that we've used in scorecards aren't necessarily going to be relevant now, and particularly inflation, where the data, we haven't got the historic data on which to model. But actually, are there other factors that we can use as a proxy for affordability that we do have the data for, that we can actually look at using those in the models? So I don't think it's modelling per se that and credit scorecards that's the problem. I think we just need to look at them a little bit differently and rethink what goes into those models to make sure that they're appropriate going forwards.
Yeah. And Karien, you're in the credit card world, which is usually pretty dynamic as well. I mean, what's your kind of view on that in terms of approach around maybe changing the structure of the models or thinking about it in a different way?
Yeah, so I'm also put high value on the scorecard side, and that just gives you a lot more power than, of course, just having a set of policy rules. But I think that one of the key things that you have to look out for is early indicators. So scorecards are built on longer term outcomes, and it's making sure that you pick up and try and calibrate it to a early type of outcome so that you can react quick and make changes and not have to wait too long for those longer and more severe arrears to kick in. So a lot around monitoring. Also agree on the data side. The data has been manipulated by different things that have gone on. So it is just making sure that if you've got that monitoring in place and using your own data to rebuild, that will give.
So it's almost like monitoring the effectiveness of the models using statistical techniques to use it, and almost like, do you think that that's going to increase in the frequency? So you have to model them even more closely, and we're probably going to end up having to remodel, go through all of the process around looking for new attributes to put in and remodel it on a more frequent basis.
Yes, but I mean, with machine learning and the way that scorecards are being built now, we are so much quicker at getting models out. So we have that ability to react quicker and do a new model. It's not that you have a model in a year and you take 3 months to rebuild a new model. So we have that ability, and that will make us better. And
it's quite a lot different from the 1970s when we last had inflation. So it's all done by hand and calculator, probably. So, yeah, so it's interesting in that, I mean, machine learning sort of there, and I mean, that's a good way of sort of like filling an immediate need to a certain extent. We've been talking about it for a long time, but do you think that's a technique that is going to have to just get used more often if we're going to have to like remodel on a much more frequent basis?
It's not just remodeling on a more frequent basis. It's understanding that we've got a large amount of data points. We're getting more and more data that we're ingesting. In terms of open banking data, it's absolutely huge, isn't it? The amount of data you can consume just in that before you add potentially credit files and whatever on top of that. So the amount of data we have to consume is really growing at an exponential rate. And to understand how all those kind of those elements interact, we need to kind of really use machine learning to understand those. Also, a machine learning tool is generally better to understand how different elements within those sources of data are starting to become more important than they would do before. If we use a logistical regression tool that maybe picked out 17 characteristics from a credit file, those characteristics are probably not going to be as useful indicators now as they were 2 years ago. And even using a machine learning tool can pick out the kind of what is newly useful to you. But for me as well, in terms of like the machine learning and the kind of the overall kind of continuing piece in terms of scorecards, I think what we're seeing more and more, I'm sure all the people on call are doing this more and more, is actively monitoring and using those tools that we have primarily used from an acquisition basis or primarily focused on an acquisition basis to monitor our existing book as well, and to kind of monitor the existing book and whether or not, okay, can my customer suddenly not afford this? Is my customer's behavior either with ourselves directly or in the open banking world or credit file world where we're getting the data from, is their behavior changing, and can we reach out to the customer before they've started to go bad, before they have problems? Can we help them before they are approaching us having to have difficulty and then needing help? I think we're seeing more of that.
What re-adjudication today, even though you might have been a customer for 5 years, would you be approved today? And then see if the answer was, well, it looked like you might be financially stressed, or you're outside of the risk curve, and take some action around that.
Yeah, I mean, it goes even before, more than that, really. It's basically like, can I? Because there are some people that we would approve today, but that, given the information you know from an actual customer basis, so the interactions, the behaviour of that customer, might be indicators you wouldn't know on an application basis. So you know those stresses and strains that are coming on the customer a bit more, especially with things like credit cards and whatever. You know a lot more about their behaviours there and the contact behaviour, etc. You can understand that customer more than you would on an acquisition. So it's going more in depth than you would do from an acquisition basis to understand whether and help the customer before they need help, before they have problems, before they even realise, especially with open banking, you can see that they're having problems before most people understand that they are. You see it in the open banking. They're basically like, okay, your income is staying stable, your costs are going like that, but you're not doing anything about it because they've not gone over your expenditure is not over your income, so you've still got some disposable left, and you're not doing it about it. You can see those things before that customer is even reacting or understanding themselves.
It's a bit like the Facebook idea, where it's sort of like Facebook seems to know that I need to buy slippers before I actually need to buy slippers.
Yeah, I mean, it probably still advertises slippers once you've already bought one pair, but
but it's different aspect. But from a financial services point of view, it's kind of like, well, probably if you use open banking data, you might know that they're in financial difficulty, or they might have a high propensity of financial difficulty before the customer actually is to a certain extent. Tim, you were going to jump in. You were going to jump in there with some.
Yeah, I was going to say. I mean, we've collated a staggering. Each consumer shares with us 4,000 to 6,000 data points, which is sort of 12 to 14 months worth of open banking. And I defy anyone to sort of manually go through that and be able to make decisioning. Although we have been doing that, we've now got a machine learning piece that we put in as of last month, August, and we're deadly keen to see the results and the outcomes of the decisions that has assisted us with. I think there's a big we're now on model 5. We've only had it for 4 weeks. Choosing the right variables to make a difference and testing that and understanding it. We've got a team of 3 data people on that full time, which is really unusual for a small business like ourselves. What I would say is you can never underestimate a financial life shock with the consumers that we serve. So you see stable long-term employment because they are in public sector, and it's fairly vocational in most instances. But you get these life problems. I know we mentioned the sort of broken down boiler, but there are a whole host of other things that we have in a feedback with the customer. Long-term illness, mental health problems, social justice problems up in the northwest and the northeast. Other things that just hit them, and they have zero resilience, and they need an immediate answer to that problem in the form of a loan, in effect. So I'd love to think that we could sort of see that, rising expenditure and, declining income. But for our consumers, certainly the people that we serve, it tends to be a one-off cataclysmic event. And we saw a lot of that with in COVID, with partners being laid off, made redundant, furloughed. Death as well. That's another thing that you don't tend to brush up against, but we were seeing, spousal loss, and that has an impact on the family unit. So I think it's about remediating our consumers as well is really important. And I think it's not just, can't pay, won't pay. That's an increasing part of the business that we see, which is helping to get customers back on track and recognizing that the people we serve will have problems. So I think, rehabilitating customers is as important for us as lending appropriately and affordably.
And there's certainly scope for that with the economic and the energy shock that's coming in. I mean, in terms of those almost like black swan events, those events coming through, the income shock, for example, like in the restaurant sector or those kind of things where people could, it's quite hard to predict, isn't it?
Especially with businesses looking like they might shut down or themselves suffering energy costs. Big manufacturers in the UK just won't be able to support their workforce and continue to manufacture. So that's a real concern for me, is what happens to those big consumers of commercial energy.
Yeah, and I suppose we're all in a bit of a wait and see until Thursday to see what kind of happens, even particularly from a business point of view. I don't know what that means from an income side of the income statement, people's personal income statement. What happens then in terms of support for businesses and then energy supplies as well. Just turning a little bit to the future. I know we talk quite a lot about the future, but what else do you think we need to be aware of? What else do we look at? We talked a bit about the economy, a bit about energy, talked a bit about data. What other things are you thinking about that we should be focused on, or is that the totality of everything that we're taking up all our time during?
Long-term weather forecast, Chris, might be useful. Can you imagine if we have a shocking winter, what that's going to do to people?
Yeah.
I know it's one of the weird things, but people are all saying you're going to turn your heating on in October. Well, I don't think I will be.
Yeah.
We'll be putting on extra layers, etc. But I'm joking about it, but it is going to be a real issue if we have a really cold winter for people. And that's whether it comes this side of Christmas or the following side, which it normally does typically.
But it's also quite interesting looking at the interconnected nature of the world as well, and globalization. So for example, if Germany has a very cold winter, what does that do in terms of their gas consumption, which then impacts us as well to a certain extent, even if it's just in terms of pricing. Any other things that so we've got the weather, so we've got to look out for the weather. We do talk about the weather quite a bit, but that's a fair call into the because that's a multiplier effect that goes on energy costs, isn't it? Any other things that you guys are sort of thinking about? Well, we've got to watch out for that. We certainly rerunning the models, looking at credit risk adjudication more frequently, the effectiveness of modelling.
So I think the one that we've not necessarily spoken about is the unemployment rate. So historically, that would be what was one of the strongest indicator of pressures from a risk perspective, because at least if a customer has employment, even if there's pressure on that disposable income, they can pay something, or there's at least they can manage it a little, and there's that sort of road out of it at the end of the pressure time. But if the unemployment rate does get impacted a lot by all us people not spending and certain sectors being impacted, and I think that's when we'll see the real pressures from the risk side.
Dawn, any kind of thoughts from your side?
Yeah, I mean, I agree absolutely. I mean, fortunately, we're not really seeing anything on the unemployment at the moment, and the market is tight. I mean, you're seeing vacancies everywhere. I think just for me, I think it's just around sort of the legacy of COVID as well, and to which to the extent that actually the sort of the end of the payment holidays are actually impacting people's credit files. And what are we actually seeing the true picture of the event? And I think that's something that we just need to be mindful of. But I think absolutely unemployment is really key. But actually also the impact of vulnerable customers and the whole consumer duty as well. And whilst that's not directly credit risk, actually it's going to become a huge part of the actions that we take and just how we look at our customers and how we treat them.
Jon, any thoughts?
Yeah, for me, I'd say I agree with all the kind of points that have been raised before. For me, one of the things that we're also looking at is how to improve our contact strategy and how to improve the way we select the right tools, I suppose, from a collections or customer contact basis. At the end of the day, a lot of these things are still run on a kind of systematic basis in a very old school way. However, we want to make those kind of more individualistic. We want to use what we know about our customer to show which are the right forbearance tools for our customer to make the right outcomes for them. We want to contact them in the right kind of way. I find it incredibly frustrating to some degree that we spend so much money on marketing and whatever to make sure we have exactly the right message going out to exactly the right people, and then when their own customers, we don't use any of that, and we have the same contact strategy for pretty much everybody. Yeah. We should be, and we are looking at different ways to be able to identify the best way to contact them, to get the message across, to make sure we have the best outcome for both parties. It's basically all about, for me, being a very individualistic experience for the customer to make sure we get the right outcomes everywhere.
Joined up thinking there across the life cycle. There's a question just coming around open banking and whether giving customers a choice around open banking, and I suppose just that those that don't, maybe do they get a different level of service versus those that do? I mean, what are your views in terms of like giving people a choice whether to use that or not? Just given the extra level of information it kind of gives.
It's interesting, Chris. we only use open banking. We don't use bureau scores at all. And you can't make an application without giving us access via Yapily, our AISP, to open banking. It is interesting the people that pull out of the process in the funnel, but the vast majority of our applicants will go through that open banking process. If they don't, there's usually a reason why they don't want to. There's still a few banks that aren't connected to open banking, which is a little bit annoying. Metro Bank, consider yourself chastised. Yeah, we only make a decision against open banking, and consumers are very happy now. The journey is a lot smoother. Back in 2019, it was jerky as you like, but now it's a very straightforward tap, tap, tap on the mobile, and you're in, and it's done. So I think there's a greater acceptance of open banking, especially in that trade-off between, if you use this, I might get a better rate, or I might get a faster decision. So we've never seen a problem with consumers wanting to connect open banking to us.
Do you think, just maybe for the rest of the group, do you think it's going to be will there be a problem with almost like inclusivity around people who don't want to use it versus those that do? Do you think, is that a theme that's going to come through? Because it's been a big boon, Tim, clearly. It's a big boon in terms of like that extra information. You probably couldn't make the decisions you make without it, right?
Not at all.
Do you think there'll be pressure, maybe talk about this in the regulatory piece, around inclusivity around people who don't want to use it?
I think you're always going to run against those problems in terms of the data being available. It's not that dissimilar to a discussion in relation to, is a customer having a thin file? If I'm relying solely on credit file information, is that customer going to get a different decision? Yes, because I haven't got as much information to make a correct credit risk assumption. So I can't say that they're not going to get a different decision, or they're not going to get a different credit rate than they would give elsewhere if I knew everything about this customer. So yes, it does make a difference. There's no getting around in relation to that, but it's always going to be the same. If I've got to have enough information to allow me to properly assess it, and if I don't have enough information, then I've got to put you in a bucket, which is I haven't got enough information. I either decline you, or I put you through a whole different journey, which is more painful, from a kind of customer service perspective.
To a certain extent, that's the nature of credit risk assessment, isn't it? The information you have versus not.
It is. Sorry, I think it's also that education piece for the customer, and understanding what is the value proposition for them. So, like in Tim's case, where they have to do that connection to get that lending. But if we can create value for the customer and understanding with the customer of why they should be supplying that open banking information and what value that generates for them, then I think we'll get better uptake in the market.
Yeah, the way I've kind of described it before, and I know we're kind of people have discussed this with the people on call before. I do find it. I think about making sure that we do sell that value exchange is very, very important. But people already do value it. In kind of Tim's case, they evaluate it every time because they understand that. I believe that our company does quite a good job of understanding that as well. So we have a 85, 86% take-up rate in terms of open banking with ourselves as well. But it is something that people already do those value exchanges for a lot less than we do, than open banking gives you. That log in with Facebook, log in with your Apple ID and things like that, whatever, is giving away so much more data for the simple reason that basically I don't want to create another person who I have to fill in a form for to register. You will happily give away your sexuality, who you live with, how long you've been married, or your relationship status, everything about you. You're potentially giving just basically to not log in. If people understand the value of those value exchanges, as long as we advertise or kind of communicate the right kind of way what customers are getting out of that exchange, they will do so.
We've got to hold some of the thoughts around affordability because that's the next session. So Gigi, you can come in and ask questions as well for the panelists. So affordability is the next session. But certainly it seems like there's just a huge amount of change, and a little bit just summarize what we've talked about. I mean, there's a change of mix, there's changes in the way we need to think about our models, change in terms of the data we're kind of using, and I suppose just making sure we've got that flexibility going forward. I mean, it feels like we're in a bit of an inflection point. I suppose we see sort of how things are going to pan out over the next week or so, but it does feel like change is quite a big theme again. So, Colin, I see you appeared. It's probably the end of our time, but so Dawn, Jon, Karien, and Tim, I also wanted to thank you very much from my point of view for being great panelists and a really interesting conversation.
Thank you.
Thank you.
Thanks, Chris. Just want to echo, obviously, that as well. Thank you to our panelists. Really, really interesting. And a lot of things to digest from that as well, and what's coming up over the winter as well in terms of the weather. Unbelievably, I mean, it is a bigger factor than ever now, isn't it? So, yeah, scary times in that perspective. But we're hoping there'll be some solutions, and at the end of the day, we've still got to move on with our life. So, yes. So as Chris mentioned, our next session we're going to start at 10:45. That's going to be looking at measuring affordability. We've got a number of good speakers lined up for that one, as we did here. But I'd like to echo what Chris said. Thank Dawn, Karien, Jon, and Tim for their insight, and of course Chris for chairing for the session. Chris will be joining me on the next session at 10:45. If you want to log into that session now, you can do so, and there's a link within the text within the screen that you can see, and log into that now. We've got other sessions later on as well. But for now, we'd like to say thank you to our panel and for everybody who's tuned in, everybody's asked questions, and we hope to see you all again soon. Thank you very much. Cheers.
That's
Bye-bye.
great. Thank you.
Bye now.